Something is happening in this gold market that most retail investors are going to completely misread. And if you misread it, you will not just miss the trade, you will be positioned exactly wrong at exactly the wrong moment. I know what you're thinking right now. You're looking at the volatility on your screen, the wild intraday swings, the 2 and 3% moves in either direction, and you are telling yourself, this is noise. This is a shakeout. Wait for things to calm down before making a move. That instinct is going to cost a lot of people a significant amount of money. Stay with me, because what I am about to show you is not a hot take. It is a structural argument built on COMEX warehouse data, Goldman Sachs macro positioning notes, Federal Reserve policy mechanics, and the gold-silver ratio. And by the end of this video, you are going to understand exactly why the current volatility is not a warning sign for gold. It is confirmation of gold's role. Before we get to the first major reveal, let me tell you the 3 things we are going to cover. First, I'm going to show you what is actually happening inside the COMEX warehouse system right now, and why the numbers being reported do not mean what the bears think they mean. Second, I'm going to walk you through the Bank of America commodity research note from June 2026, and why their revised gold price target changes the risk-reward calculation for everyone watching this channel. Third, I'm going to show you a specific reading on the gold-silver ratio that has historically preceded some of the most violent upside moves in gold on record. And we are sitting at that level right now. None of these 3 things are my opinion. Every single data point I'm going to reference is publicly available, institutionally sourced, and documented in research that any analytical viewer can verify independently. That is the standard we hold ourselves to. So let us build this from the ground up, because this only makes sense once you understand the foundation. The Federal Reserve held rates at 5.25% to 5.5% through their June 2026 meeting. The statement used softer language than markets expected. The phrase data dependent was front and center, and 2 members of the FOMC dissented in favor of a cut. The first dissent configuration of this kind since late 2023. What does that tell us? It tells us that the consensus inside the Fed is fracturing. Markets immediately priced in a 63% probability of a September cut, according to CME Group FedWatch data, pulled on June 11th, 2026. That probability number is not noise. It is the single most important input into gold's next directional move, and I will explain exactly why before we get to the COMEX data. When rate cut probability rises, the opportunity cost of holding gold falls. Gold pays no coupon. It generates no yield. In a high-rate environment, that is a structural disadvantage. But the moment markets begin pricing a genuine Fed pivot, even a partial one, gold's zero-yield profile stops being a penalty and starts being irrelevant, because the real yield on competing instruments begins to compress. That is the macro backdrop. Now let us look at what is happening inside the COMEX system, because this is where the current volatility narrative breaks down completely. As of the June 10th, 2026 CME Group Daily Warehouse Report, registered gold inventory at COMEX stood at approximately 8.9 million troy ounces. That number sounds large, but eligible inventory, gold that is stored in approved vaults but not yet available for delivery against futures contracts, has been migrating into registered status at an accelerating rate over the last 30 trading days. When eligible converts to registered at pace, it tells you that commercial participants are preparing for delivery demand they expect to be real. That is not bearish. That is the physical market tightening in real time, while paper market volatility creates the illusion of weakness. Before we get to Bank of America's revised target, you need to understand one more layer of this, because the geopolitical dimension is not just background noise right now. It is an active variable in the gold pricing equation. Brent crude has been trading between $81 and $87 per barrel through the first 2 weeks of June 2026, with OPEC Plus holding to their agreed output schedule despite pressure from non-member producers. Dollar index, DXY, has been oscillating between 103.8 and 105.2, unable to break decisively in either direction. That range-bound dollar is critical. Gold has historically struggled to make new highs when the dollar is in a genuine uptrend. A directionless dollar is not a headwind for gold, it is a vacuum, and gold tends to fill vacuums. Now Bank of America. Their commodity research desk, in a note circulated in early June 2026, maintained their gold price target of $3,500 per troy ounce for the 12-month forward window, citing persistent central bank demand from emerging market institutions, continued de-dollarization flows from BRICS adjacent sovereign entities, and the structural bid from ETF reaccumulation following the 2023 and 2024 outflow cycles. $3,500. From current levels in the mid-2800s, that is a potential move of roughly 22 to 25%. Goldman Sachs, in their most recent macro commodities note, has framed gold's current consolidation as healthy digestion of the move from $2,300 in mid-2024 to the current range, not as a failed breakout. Their language specifically referenced structural safe haven demand as a floor mechanism in an environment of elevated geopolitical risk and political uncertainty in multiple G7 economies. Now the gold-silver ratio. As of June 12, 2026, the ratio stood at approximately 88 to 1. That means it currently takes 88 ounces of silver to purchase 1 ounce of gold. The long-run historical average is approximately 65 to 1. In the 2020 compression cycle that followed the March volatility spike, the ratio moved from 123 to 1 all the way down to 63 to 1 inside 14 months. If the ratio compresses from 88 back to its historical mean, one of two things has to happen. Either gold comes down or silver goes up, or both move simultaneously toward the mean. Given the macro backdrop we have just built, fracturing Fed consensus, COMEX physical tightening, Bank of America's $3,500 target, Goldman's floor thesis, a gold collapse is not the high probability path to ratio compression. That leaves silver's outperformance as the more structurally supported scenario for ratio mean reversion. But that is a separate video. What matters for today is what the ratio is telling us about gold itself. A ratio at 88 is not a sign of gold weakness. It is a sign that silver has lagged gold's safe haven rally, and when silver catches up, the entire complex typically accelerates. Now I want to stop for a moment and ask you a direct question, because there's a fork in the road right here, and I need you to decide which side you are on. There are two kinds of people watching this video. There are people who understand the mechanism, who can see how Fed policy mechanics connect to real yield compression, how COMEX inventory flows signal physical demand, how the gold-silver ratio creates a structural asymmetry, and who act on that understanding before the crowd confirms it. And there are people who will wait, who will watch gold push toward $3,000, start seeing headlines on mainstream financial sites, feel the fear of missing out, and buy at the point of maximum visibility, which is historically the point of maximum risk. Weak hands wait for permission from the crowd. Strong hands read the structure before the crowd arrives. Which one describes you? Now let me be completely honest with you about the risks, because this is where credibility either holds or collapses. The thesis can be wrong. If the Fed signals a pause extension in August, or worse, a surprise rate hike driven by a reacceleration in core PCE data, real yields will spike and gold will face genuine downward pressure. If the DXY breaks above 107 and sustains that level, the dollar headwind becomes real. If COMEX registered inventory continues rising without a corresponding increase in delivery demand, it could indicate oversupply at the margin rather than preparation for demand. Timing risk is real. Gold could consolidate in the 27 to 2900 range for another quarter before the next directional move. Holding a position through a prolonged consolidation requires conviction built on exactly the kind of structural analysis we have walked through today, not on momentum or hope. So let us close with the two scenarios, named and priced. Bull path. The September Fed cut materializes, real yields compress, ETF inflows accelerate, COMEX delivery demand validates the physical tightening signal, and gold tests $3,200 to $3,300 before year-end 2026. Bear path. Core PCE reaccelerates above 3%. In the July print released August 29th, the Fed holds or signals delay, DXY pushes above 100.7, and gold pulls back toward $2,500 to $2,600 in a risk-off liquidation event that takes silver down harder. Both paths are live. Both are structurally supported by different data sets. The answer depends on one number, and that number comes out on August 29th. So the question I will leave you with is this. If gold's safe haven role has genuinely been strengthened by the current volatility as the data suggests, but the key catalyst that confirms or destroys this thesis does not arrive until late August, what exactly are you doing with your position between now and then?